Last week, I came across a very insightful New York Times column entitled Aging in Place or Stuck in Place? A good question. It says when it came to housing, Susan Appel and Keith Irwin, her partner, thought they had planned adroitly for later life, and they purchased a 4-bedroom home on 2 acres in Lebanon, New Hampshire. That was 24 years ago. And they say, we made sure to pay off the mortgage before we retired. Now, that way, the home equity they had built up, at least that was their plan, which they estimate is now worth about $700,000, would allow them then to sell and downsize into a more manageable property when they needed to, or right-sizing as we call it. That time has arrived. Miss Appel, a retired law professor, is having trouble climbing the stairs, and Mr. Irwin, who's 71, previously an account manager for a local business, is wearying of yard work and snow shoveling, and now he's hiring out workers to do those chores instead, but it still remains difficult. We're seeing the writing on the wall, said Miss Appel. They have started shopping for a nice 2-bedroom condominium in the area with a little den all on one floor. But with today's housing market, they can't find one. Local developers are now putting up 4-level townhouses with even more stairs, and the few suitable 1-floor homes available on the market get instantly snapped up. City dwellers that fled COVID helped pump up housing prices, and one unit that the couple looked at cost about $950,000 and still needed repairs. Now, even those tiny shoeboxes today in their area are selling for $600,000. So aging in place or stuck. We were very grateful to live in this lovely place and to have paid off our home, said Miss Appel. It never occurred to us that it didn't give us the ability to move out of it. 80% of older adults live in homes that they own, but the traditional notion that a house as a paid-off mortgage can serve as an ATM to fund retirement, well, that is beginning the shift, according to economists. Home ownership is no longer an unqualified benefit for some seniors. Are they aging in place or stuck in place? Asked Lena Zhu, a research economist at the Urban Institute. Do we need to rethink this so-called American dream? It worked for previous generations, but does it still work today? The proportion of older adults with mortgage debt has been increasing for decades. From 1989 to 2022, the share of homeowners aged 65 to 79 that still had a mortgage balance climbed from 24% to 41%, according to the Harvard Joint Center for Housing Studies. And reverse mortgage professionals, you'll want to take note of this. The proportion or percentage of older adults with mortgage debt in retirement has been increasing for decades. From 1989 to 2022, the percentage of homeowners aged 65 to 79 with a mortgage climbed from 24% to 41%, according to Harvard Joint Center for Housing Studies. And larger mortgage balances and higher interest rates, also along with higher property taxes, homeowners insurance, and other various costs related to housing, help make 43% of older homeowners that have a mortgage feel cost burdened. Now, cost burdened is defined as anyone spending 30% or more of their income on housing and housing-related costs. With a report released earlier this month showing that inflation is increasing yet again and the prospect of interest rate cuts from the Fed's next meeting fading quickly, many Americans now find themselves looking for more ways to boost their bottom line. That's especially true for seniors, many who may be relying heavily on Social Security benefits and retirement savings. And for this demographic in particular, it's important to explore alternative ways to both protect their existing funds and improve their potential cash flow, according to a recent column in CBS Money Watch. Fortunately, there are many ways to accomplish both goals right now. And we're going to review the 3 moves that they say seniors should consider with inflation remaining high. The first is to invest in gold. It's been an effective hedge against inflation, and it's not based on a fiat currency, which can be devalued by money printing. Gold is especially attractive right now and can help offset the negative influence of inflation because the value tends to remain steady or even increases during economic turmoil. And that's been the case in recent weeks as the price of the metals has surged to record highs. But the diversification it can offer is also key for seniors with portfolios that are mostly made up of stocks and bonds. Now, in that case, gold can help balance the performance of those assets and offer another layer of protection that is valuable today. The second is to consider a reverse mortgage. If inflation and higher borrowing costs have dramatically affected your available cash, says the columnist, Homeowners 62 and older should consider turning to a reverse mortgage. That loan, based on your home's appraised value at the time of application, will only need to be paid back if you sell the property or you die. And while it may not be ideal to tap into your existing equity, especially if you're planning on leaving it to loved ones following your death, it is still preferential to going further into debt. Now, for many, it can be a smart way to supplement their limited retirement income presently. The third is to review your bank accounts. The most recent inflation report showed a 3.5% growth of inflation, but if you're only getting a 0.5% or less on your savings, then you're going backwards. You're losing money each month and not keeping pace with inflation. As such, the columnist says it's wise to periodically look at your bank accounts for opportunities to find higher yield interest, and that can help offset some of the impacts of inflation. Money market accounts or high yield savings accounts are especially helpful. So this column, I have to give credit, does look at some practical ways one can hedge against inflation or deal with its impacts in meeting their daily needs and covering the cost of living. And it's good to hear that a reverse mortgage was included in those options. This week, we return with Reverse Market Insights' John McCue, and John will be updating us on the latest trends in the home equity conversion mortgage marketplace. John, what do you have for us this week?
Right. Thanks again, Shannon, for having me back yet again. I really appreciate it. This month I wanted to, kind of start the same way I did last month and talking about case numbers first, because not only are they, the earliest indicator of what we can expect going forward, there's also kind of been some interesting things happening. So February case numbers actually rose another 10% to 3,237 case numbers. New equity takeout rose 10.7% to 2,668, and purchase gained another 15% to 160. The one that's really of interest is the refinances. They grew another 8.8% from January's numbers to 409. But since December, so essentially since the beginning of this year, January and February, they've grown over 105% since December. Obviously, MCAs have increased. October was the height of the 10-year annual CMT. So it's just really interesting. In January, I thought it was interesting, but now we have 2 months in a row of increasing refinance numbers. So it would be very interesting to see how many of those close, and if that, kind of trend continues, and for how long that trend will continue. As channels, this was something that's kind of interesting, but it's just a 1 month look right now. So in February, retail growth actually declined by nearly 16%, 15.7%, while wholesale grew almost 4% at 3.9%. I was asked, why do we see this? And to be honest with you, this is just a 1 month. Sometimes we have these things. I do know that some people, as through conversations, have gone back to straight, wholesale, basically going back to being brokers, just from a cost perspective with volumes where they are. So that could be part of the decline on the retail, part of the rise on the wholesale. But again, we'll just have to kind of wait and see what happens here. February endorsements, they did drop by nearly 12% to 1,900 loans, but in March they rose. So they rose by 8.3% to 2,058. In fact, 6 of the 10 regions were up in March. So if we looked at the Northwest Alaska, they're actually up 23% to 166 loans. Rocky Mountain increased 17% to 185 loans. And the Southwest was up 15% to another 230 loans. So, we actually had, some decent increases, unlike last month, which all the regions were down. So it's nice to see kind of a little bit of recovery here. As far as the top lenders trends are concerned, we have 6 of the top 9 showing growth. It's not the top 10 here, at least we're not counting them because Open Mortgage is no longer originating at HECM. So 6 of the top 9 actually showed growth. Guild rocketed almost 97% to 57 loans, while Good Life TMAC rose again for the third consecutive month by 26.2% to 82 loans. and Liberty jumped another 25% to 84 loans. So all in all, we are starting to see some positive movement, both in case number assignments and endorsements. That definitely we'll be watching going forward what's happening with the HECM refinances. So long story short, not everything is doom and gloom as we kind of ended 2023 with. So let's hope that things are kind of turning the corner here and people are kind of getting used to the new normal. Until next month, we'll talk to you then.
Reverse Mortgage Daily reports in Housing Wire that earlier this month, a California-based multi-channel mortgage lender, CMG Financial, announced that they had acquired Norcom Mortgage's retail assets to expand their operations in the northeastern U.S. That deal, however, will not be including the core members of Norcom's well-known team of reverse mortgage professionals, notably John Luddy, Norcom's Senior Vice President of Reverse Mortgage Lending. Many of you remember his videos here on HECMWorld. Now, in interviews with RMD, Luddy and other main members of that team, including Vice President and branch managers Garrett Duffy and Robert Philippone, explained that they're going to be aiming to find a more optimal fit for their continued origination efforts of reverse mortgages in the future, but it wasn't going to be CMG. Norcom's owner, Phil DeFranzo, who I've worked with for 10 years, has sold the company to CMG, said Luddy to RMD, and I was offered a wonderful opportunity at CMG. They were very gracious to me and generous in their offer, but at this time, I just don't feel like the right mix, the right fit for me and my team. But Luddy did praise DeFranzo for their dedication, long collaboration, and says that he has never had a bad day while he's been at Norcom. But he also reiterated that CMG did not seem to be the right fit for them presently. Luddy said, so I chose not to take that offer. Luddy and the core members of Norcom will be staying aboard long enough so they can close out their current loan pipeline. And after that, they're going to be looking for a new home, which I think there's going to be many offers on the table. I don't think it'll be very long, especially with their skill set. Phil has been very generous to let me clean up our pipeline, said Luddy. I don't want to leave any seniors hanging, so we're going to get those loans cleaned up before we move. We'll be moving some portion of the group all at once, and then others will come along afterwards. Thank you for joining us for this episode of HECMWorld Weekly. Don't forget to subscribe where you can continue to receive these episodes. Now, if you are someone who prefers to listen, we also have this show on Apple Music, Spotify, and Podbean. And of course, you can subscribe to our podcast videos each and every week on our channel, HECMWorld, and you can do that and hit the notification bell. That way you never miss an upcoming episode. Thanks so much for joining us, and be sure to return next week for more reverse mortgage news you only find here at HECMWorld.